Lesson 1. Understanding Investing. Investing is the act of allocating resources, often money, with the goal of producing a profit or income. You may invest in projects such as investing money to start a company or in assets, such as purchasing real estate with the idea of reselling it at a higher price later. The underlying premise of investing is the expectation of a statistically significant return in the form of income or price appreciation. The assets in which one may invest and earn a return are fairly diverse. In investing, risk and return go hand in hand. Little risk usually equals low expected earnings, while more risk is generally connected with higher returns. Certificates of deposit, CDs, are regarded as low-risk investments. Bonds or fixed-income instruments are rated higher on the risk scale, and stocks or equities are deemed riskier. Commodities and derivatives are typically considered to be among the riskiest investments possible. It's also possible to invest in something practical, such as land or real estate, or something delicate, such as fine art and antiques. Risk and return expectations might vary substantially within the same asset class. A blue chip on a New York Stock Exchange, for example, will have a much different risk-return profile than a microcap on a small exchange. The kind of asset determines the returns produced by it. Many stocks, for example, pay quarterly dividends, but bonds normally pay interest quarterly. Different types of income are taxed at different rates in various nations. In addition to regular income, such as dividends or interest, price appreciation is an important component of return. As a result, the total return on investment is the sum of income and capital appreciation. Dividends have been provided around 1/3 of total equity return since 1926, according to Standard & Poor's, while capital gains have contributed 2/3. Types of investments. While the world of investing is vast, the following are the most common types of investments. Stocks. When a person buys stock in a corporation, he or she becomes a partial owner of the firm. Shareholders are stockholders who may participate in a company's growth and success via stock price appreciation and monthly dividends paid from the company's profits. Bonds. Bonds are debt obligations issued by entities such as governments, municipalities, and corporations. When you buy a bond, you're buying a piece of an entity's debt and are entitled to periodic interest payments as well as the face value of the bond when it matures. Funds. Investment managers administer funds which enable investors to invest in stocks, bonds, preferred stock, commodities, and other assets. Mutual funds and exchange-traded funds, or ETFs, are the two most frequent forms of funds. Mutual funds do not trade on exchanges and are valued at the end of the trading day. On the other hand, ETFs trade on stock markets and are valued constantly during the trading day, similar to equities. Mutual funds and exchange-traded funds, ETFs, may either passively track benchmarks, such as the S&P 500, or actively manage indexes, such as the Dow Jones Industrial Average. Investment trusts. Another kind of pooled investment trust, the most prevalent of which is real estate investment trusts, or REITs. REITs invest in commercial or residential real estate and pay out monthly dividends to their shareholders based on the rental income produced by these assets. REITs trade on stock exchanges, giving investors with immediate liquidity. Alternative investments. This is a catch-all phrase for hedge funds and private equity. Hedge funds are so called because of their capacity to hedge their financial bets by going long and short on stocks and other assets. Private equity allows companies to obtain cash without going public. Hedge funds and private equity were formerly only available to wealthy investors who might tight income and net worth requirements. Referred to as accredited investors, alternative investments, on the other hand, have lately been introduced in the form of fund designs that are available to normal investors. Options and derivatives. Derivatives are financial products that have their value decided by another instrument, such as a stock or index. A common derivative is an option, which gives the buyer the right but not the obligation to buy or sell a security at a fixed price within a certain time frame. Because these derivatives are usually leveraged, they're high-risk, high-reward investments. Commodities. Commodities include metals, oil, grain, and animal products, as well as financial instruments and currencies. Commodity futures, which are agreements to buy or sell a particular amount of a commodity at a fixed price on a specific future date, or exchange-traded funds, ETFs, may be used to trade them. Commodities may be used to both hedge risk and speculate.